Gold is trading above $4,600 an ounce, and that creates a very tempting headline. On 11th August, the London Bullion Market Association published a snapshot survey of 16 professional analysts. Their average year-end forecast for gold was around $4,500 an ounce. So if gold is already above that level in August, have the analysts already been proven wrong? No. And that is exactly why this story is more interesting than it first appears. Because a year-end forecast is not a price ceiling. It is not a line that gold is supposed to stay beneath until December. And when you read the rest of the LBMA survey, the apparent contradiction starts to disappear. The survey was conducted during July, after an extraordinary first 7 months for gold. According to LBMA, gold had reached an all-time high of $5,501.70 on 29th of January. It then fell as low as $3,978.55 on the 1st of July, before ending July at $4,026.60. That is an enormous range for one of the world's most established monetary assets. The same survey put the average year-end expectation at roughly $4,500. The highest year-end forecast was $5,100. The lowest was $3,879. But there was another number in the survey that matters even more for what is happening now. The analysts' forecast highs for the second half of the year ranged from $4,872 to $5,800. In other words, every analyst in that range expected gold could trade materially above $4,500 at some point in the second half. Early on, 27th August, spot gold was around $4,619 an ounce. That is above the survey's average December level. But it is still below even the lowest second-half high cited in the LBMA survey. So the idea that gold has somehow smashed through the analysts' maximum expectation is simply wrong. What has happened is subtler. The market has moved above the average destination those analysts assigned to the end of the year. That is not the same thing as moving outside the path they thought was possible. Think about what a year-end forecast actually means. Suppose an analyst expects gold to trade at $4,500 on 31st of December. Gold could trade at $4,700 in August, $4,300 in October, and still finish very close to $4,500 in December. Nothing about that path would contradict the year-end number. A December destination is not an August speed limit, and there is another reason to be careful before declaring the survey wrong. The same LBMA pulse check forecast a whole year average gold price of $4,604. For the first 7 months of 2026, LBMA says the actual average had been $4,595.75. Those two numbers are remarkably close, so the survey is not a story about professional analysts being obviously detached from the market. It is a story about how difficult it is to compress a volatile price path into one number. And volatility is the key word here. At the end of July, gold was just over $4,026. By the morning of 27th of August, it was around $4,619. That is a move of roughly 15% in less than a month. The useful question is not whether one headline number was crossed. The useful question is what changed quickly enough to bring gold back above 4,600. There is no single clean answer. One important development came from the United States Treasury. on 19th of August. The Treasury announced that it would at least double the maximum size of certain liquidity support buyback operations for longer-dated nominal Treasury securities, from $2 billion to at least $4 billion per operation, beginning on 9th of September. The Treasury's stated reason was market liquidity support. That is the official mechanism. But markets can interpret the same policy through a different lens. Reuters reported that gold rose more than 5% last week after the Treasury move, as concerns about the dollar, government debt, and what traders have called the debasement trade returned to the market. That does not prove the buyback announcement alone caused the rally. Gold trades inside a global system with interest rates, currencies, geopolitics, positioning and investment flows all moving at once. But it does give us one plausible part of the repricing. Now, look at the force pushing in the opposite direction. US inflation is still elevated. The Bureau of Economic Analysis reported that the PCE price index rose 3.7% in July from a year earlier. Core PCE, excluding food and energy, rose 3.3%. That matters because the Federal Reserve's inflation goal is 2%. At its July meeting, the Fed kept the federal funds target range at 3.5% to 3.75%. But 3 voting members preferred an immediate quarter-point increase, so the current gold market is not operating in an environment where monetary policy is obviously becoming easier. Quite the opposite. Persistent inflation can keep interest rates and bond yields higher, and because gold does not pay interest. Higher yields can increase the opportunity cost of holding it. That is why the current price action is interesting. Gold has managed to move above the LBMA survey's average year-end level, even while the market is discussing the possibility of tighter monetary policy. That suggests the forces supporting gold are doing real work, but it does not tell us that those forces will win permanently. The physical and investment demand picture is mixed as well. The World Gold Council reported that central banks bought a net 289 tons of gold in the second quarter, up sharply from the revised first quarter level. It also reported strong over-the-counter demand. But gold-backed ETFs recorded net outflows of about 45 tons in the second quarter. So this is not a simple story where every category of investor is buying at the same time. Some parts of the market have been accumulating, others have been reducing exposure. That is another reason the year-end forecast range matters more than the average alone. An average can hide disagreement. One analyst can see a path towards 5,100 at year-end, while another sees 3,879. Those are not small differences around a shared consensus. They are materially different views of inflation, rates, the dollar, fiscal risk, investor demand, and the global economic environment. The number 4,500 sites in the middle of that disagreement. It should not be mistaken for a hard market boundary. Now, take the bullish interpretation seriously. If concerns about US fiscal sustainability continue, if the dollar remains under pressure, if central banks continue accumulating gold, and if investors increasingly want assets outside conventional sovereign liabilities, then the market may be repricing gold faster than analysts expected in July. In that scenario, the average year-end forecast could prove too conservative. But even here, the evidence does not allow us to say that has already happened. Gold would need to remain stronger through the rest of the year. Not simply trade above 4,500 for part of August. And the survey itself already allowed for second-half prices well above where gold is trading now. The bearish case is equally important. Gold has already demonstrated in 2026 that it can move hundreds of dollars in both directions. It traded above 5,500 in January and below 4,000 in July. That alone should make anyone cautious about extrapolating a few strong weeks into December. If inflation keeps the Fed restrictive, if Treasury yields rise, if the dollar strengthens, or if investors take profits after a rapid rally, gold could fall back below the current level without anything unusual happening. The World Gold Council's second quarter ETF outflows are a useful reminder that investment demand can reverse quickly. So being above 4,500 today does not prove gold will finish the year above 4,500. And being below 5,000 today does not prove it cannot trade there before the year is over. This is why professional forecasts are more useful when treated as maps of uncertainty than as promises. The most valuable numbers in the LBMA survey are not just the average, they are the range. 3,879 to 5,100 for the year-end forecasts. Second half highs ranging from 4,872 to 5,800, and a whole year average forecast of 4,604, remarkably close to the actual average price recorded through July. That distribution tells us much more about the market than one headline number. So what does gold trading above the LBMA survey's $4,500 year-end average actually tell us? It tells us that the market repriced sharply after the end of July. It tells us that gold has reached the upper side of the survey's central year-end expectation much earlier than the calendar might suggest. And it tells us that fiscal concerns, monetary uncertainty, and continued institutional demand are competing with the very real pressure created by elevated inflation and potentially higher interest rates. What it does not tell us is that the analysts have already failed. We will only know how good the year-end forecasts were when the year ends. Until then, 4,500 is not a ceiling. It is one point on a much wider map of expectations. And right now, the most important question is not whether gold has crossed that line. It is whether the forces that pushed it above the line can still be there in December.